solid quarter all around. Guidance was in line with what they had expected heading into the quarter, but a couple lingering things, higher expenses for 2026 as they continue to invest for growth. We're talking about $9 billion increase in expenses, and then the credit card cap is still lingering across JPMorgan and the large banks.
Herman, since everyone's been talking about the proposed cap by President Trump on credit card fees, what was the messaging from JPMorgan on the impact of that?
The messaging was that this would have drastic repercussions, not only for JPMorgan, the banking industry, consumers, and overall GDP growth. So you think of credit as being the lubricator for economic activity. And when you slash card rates, that really will reduce the credit availability for a lot of JPMorgan's customers. So you can think of a large swath of them just not having credit card usage going forward under a 10% rate cap.
And JPMorgan is obviously a lot more sensitive to a potential cap on credit card interest rates than some of the other big banks. I mean, this is a bank that just purchased the Apple credit card business, is taking on that Apple credit card business that Goldman Sachs gave up.
That's right. So that's adding about 20 billion in balances, give or take. So that's something that will be helpful for them. But really, JPMorgan's one of the more active credit card issuers in our large cap bank coverage. Citi is the first, followed by JPMorgan, and then Bank of America, Citi, and U.S. Bank lag after that.
What's the thing, Herman, that stood out most to you today from JPMorgan's results? Was there anything significant compared to prior quarters?
Yeah, really the takeaways were just how forceful they were on the credit card rate cap issue. Just reminding everybody that this is not just a JPMorgan and banks issue. This is going to have really big repercussions for economic activity in the United States, and really will hurt some of the less advantaged consumers that I think really this rate cap would intend to help. And then the second one is really just they double down on the expense outlook, which surprised some folks when they unveiled that late last year. So $9 billion in higher expenses, really driven by growth, inflation, healthcare costs, et cetera.
I want to go back to the president's effort to cap credit card interest rates, because from what I understand, it's not something that he has the authority to do. This is something that Congress has to pass. Yet he's talking about this January 20th deadline. How does that work? I mean, he's calling for it, but calling for it doesn't mean that he can do it.
So a lot of it seems to be posturing at this point, pushing himself to address some of the broader affordability issues heading into midterm elections is how I view it.
So why don't the banks point that out, or not point that part out, but call them out on the fact that this would take an act of Congress to do anything about it?
Well, they're not. There was a question posed during the earnings call if somebody from the administration had reached out to JPMorgan, and they said that, as far as they know, nobody has. So a lot of it seems to be just tweeting by edict at this point. So we'll see if that shakes out to be something else more definitive. But we would expect the banks to push back and really wait for any congressional legislation to come in to really cap the rates.
Herman, this slowdown in investment banking revenue, down 5% from a year earlier, do you expect that to pick up later this year given the expectation for more deal making?
Yeah, that's right. The fourth quarter seems to be more of a blip to us. Fourth quarter investment banking usually is seasonally soft given the holiday season. Sounds like from their comments that a few deals were pushed out into the first quarter. So these deals didn't go away. They were just delayed. And looking ahead into 2026, we see robust activity in investment banking. You can just think about the IPO calendar that's really firming up. And then for M&A activity, we think lower rates will help. This deregulation effort by the administration is helping increase consolidation, not only in banks, but in other industries as well. And then we've seen sponsor activity, private equity players really jump back in. So those are really strong factors for improving investment banking activity next year.